Welcome to the Ellsworth Advisors monthly update for June 2025. I'm Kelly Keenan. This is Patrick Justice. Today we will review the latest economic information, how our portfolios performed for the month, and kind of what we see coming up through for July. First of all, happy 4th of July, and we're going to kick it off with Patrick for some economic numbers.
Thanks, Kelly. Good morning, everyone. Let's start with GDP and growth numbers. According to the Atlanta Fed GDP Now, as of July 1st, yesterday, the seasonally adjusted annual real return figure sits at positive 2.5%. Over the last few months of volatility, we've seen this number bounce anywhere from plus 1% all the way up to plus 4.7% after a couple of those tariff deals were struck. So as we sit here right now, I think we'll take plus 2.5 for the current moment.
Yeah, my assumption has been we're going to be somewhere around 2% for the year. Obviously, with the variability in the data the first part of this year, with tariffs, a lot of uncertainties, front loading of imports. Really hard to say, where exactly were we. The averages, like I said, kind of tend to shake out to around 2% growth, which was somewhat expected going into the year. What I still think is happening, and a lot of economists will agree, is the economy is still softening. Once again, looking at slower growth, not recession, but definitely a slowdown in the economy. We have tight monetary conditions. Short-term interest rates are still elevated. Long-term interest rates probably seem to be in the right range, but overall, those are all signs of an economy that's slowing down a bit.
Yep. Well, speaking of inflation, the Fed really looks at three main components. You guys are familiar with these as we talk about them on a monthly basis. The major factors that the Fed thinks about. On a PCE, or personal consumption expenditure index, it rose just 0.1% in May, and it's up 2.3% year over year from May of 24. If we take out volatile food and energy, that index rose by 0.2 in May and 2.7% year over year dating back to last May. So not bad from the last couple months aspect there. On the PPI side, or producer price index side, on June 12th, the Bureau of Labor Statistics reported the index rose by 0.1% there as well, but it did advance 2.6 on a year over year basis. If we strip out food and energy there on the PPI, it edged up just 0.1 and also 2.7 year over year. So pretty in line with the PCE there. Third factor the Fed thinks about, CPI, or Consumer Price Index. The all-item CPI rose by also just 0.1% in May and 0.2% back in April. So we're okay on that month-to-month basis there. Year over year, the index increased by just 2.4% on the CPI. So we're getting closer to that 2% target.
Yeah, everything's, over 2, but, we don't have any threes at this point. So it seems like the trend is the right direction for inflation. I think we talked about it last month that, bigger picture, the inflation trend seems to be coming down. But the Federal Reserve has, really, they're still concerned about inflation, just not knowing what the tariff effects will be. I think the reality is, they raise prices on goods and services that are being imported, but how businesses deal with those increased costs, how are they passed on, if they're passed on to consumers, that's yet to be seen.
Yep.
It's rarely a dollar for dollar increase in prices. So we don't know how companies are figuring it out. It's been almost 3 months now, and companies are dealing with it. And I think the worst has been assumed in, and the fact that companies are dealing with it in creative ways, a lot of the numbers aren't looking as bad as what were expected.
Yeah, totally agree. So with those three items, Fed did decide at their June meeting to leave the interest rates, or the Fed funds rate, at 4.25 to 4.5 at this time, which, I'm comfortable with that at the moment. Jerome Powell seemed to, on that video, feel good about the labor force. felt like there was still a little bit of tariff pressure on inflation. So I think leaving it alone for the time being seemed like the right move. The market is pricing in 1 to 2 cuts this year, which I think has been pretty consistent at this point. You know, they
I think realistic by the end of the year, I think, the Fed does start reducing rates. You're hearing a lot of political pressure for him to reduce rates. I would question some of the rationale for those reasons. But the reality is some of those rationales are based on long-term rates, which the Fed does not really cannot control. So, there's a lot of false arguments out there, but erring on the side of safety is probably a good thing. We do not want inflation to, rear its ugly head again. That's always going to be destructive to the economy. On the employment side, the numbers, I mean, we consistently stayed below 5%, which is good. There are some signs out there of softening, but those signs have kind of been out there, but the employment numbers are still coming in decent. So, where's this softness? I'm not sure. Or, where's this unemployment crisis? Is there a crisis? I mean, that's the thing, is some commentary, some economists think that unemployment is worsening, but we haven't really seen it in the numbers yet.
No, I will mention that was my last data point.
Yeah.
For May, it came in at 4.2% on unemployment. This was unchanged from April. As I mentioned earlier, Jerome Powell made it very clear that he felt labor force, was in good shape. Not concerned at all. They think about stable prices and maximum employment. He has been saying that since he's been in that seat. He did not seem concerned at all, and frankly, he made it seem that it's a healthy figure,
right?
And especially amidst a lot of the tariff,
right. 4.2, kind of one of the key numbers. We start getting around 5, get a 5 handle on it, then now it's going to become concerning. How quick we get to that 5 number is the question mark. And once again, the Fed has the leverage, the ability to reduce rates, which would be a big boost. Reducing rates right now, I'm not sure if it really helps a lot. If anything, I think it could do, create some excesses, which, cause problems down the road. So my mind is better safe than sorry.
Yeah, I think it's also important to keep in mind too, just if they were to cut once or twice, bring it down closer to 4 or maybe under 4, that doesn't necessarily translate to longer term, say, housing and mortgage rates,
not
which
at
are
all.
typically tied to the 10-year.
Not at all.
We have to be aware and have to be, know that is not going hand in hand. Just because the short end and the banks lending between each other come under 4 does not mean mortgage rates are going back to 3 or 4%.
No, those are based on the 10-year, and Fed funds around 3.5. That still gives them a lot of room. It's still a reasonable interest rate where money in the bank can still actually make money versus 6 years ago when you get 0. So there will be, even at 3.5, that's still a decent short-term rate. So that's good, and you're outpacing or keeping pace with inflation. The big wild card is when are they going to do it? And on the longer end, like you said, the mortgages, that's based on the 10-year. But if you have lower short-term rates, now adjustable mortgages could make sense. And that could give homeowners, home buyers another option to make housing more affordable. Going the adjustable rate route with high short-term rates, the adjustable rates just don't look as attractive.
No doubt.
There's not that big of a spread between those and your fixed rates. So I think that will help housing a little bit. And then, business owners, a lot of business lending is done based on variable rates, which are hinged towards short-term rates.
Correct.
So that's, if things were getting tight and we got to a situation where, hey, the cracks in the economy are starting to show themselves, the Fed can always lower rates. They can do it quickly. It happens instantaneously.
Oh, we saw it the other way.
So, okay, hey, if it does get if those worst-case scenarios do play out, the Fed can reduce rates versus just doing it now because, hey, it looks like things are going to be good and, we want lower rates. I question that.
Yeah, no, totally fair. Last thing I did want to address, obviously, one big, beautiful bill right now is, as we shoot this today, it's July 2nd. is back to the House. We'll see kind of how that plays out, right? There's obviously a ton of political pressure from both sides. I think that's probably another reason why the Fed is sitting tight on rates. They're a little concerned about some additional inflationary pressure from that side.
Right. Yeah. The reality is the bill really isn't doing anything to address the deficit.
Right.
From a client standpoint, individual standpoint, looks like there's, we're not going to see any reversion back to higher taxes.
Agreed.
From, pre-2017. Looks like the estate tax is, basically locked in, $30 million per couple. So that takes the risk of paying estate taxes away from the majority of people in this country. So that's a good thing. And, the reality is a lot of people are actually going to see some tax relief. So
agreed.
That's going to be good for clients. Deficit wise, that could be a different situation.
Mm-hmm.
The reality is in our, our political world and our economy, really the way we as a country, based on our politics, have decided to go is instead of, austerity to solve our debt problem, is growth.
Yep.
And that, growth does address the, deficit problems. If we're growing, the deficits are not a problem and they get addressed. So that's the hope of the politicians. It's obviously the easier way to go if you're a politician because you're not taking money out of anybody's pockets and you're giving people money. So, that's kind of the world we live in.
Mm.
So it's all about companies growing, expanding, and, providing a landscape for companies to, to grow. Bottom line, the economy to grow.
Absolutely.
So let's jump over to how performance has been.
Mm-hmm.
We're through second quarter. So far this year, halfway through the year, we've seen markets, basically go through a 20% correction, and now back to all-time highs as of yesterday. Things are, if you didn't have any media around you for 6 months, you would think, okay, things are good.
Normal year.
No, just another year. We're just
Right.
kind of, crawling forward. Not a bad year. For the month, the S&P 500, big month, up 4.95%. For the year, taking it to 5.5%. Like I said, a decent year. Halfway through the year, up 5.5%. No big deal, but along the way, we've seen serious volatility. And, if you overreacted to anything, it probably cost you money, bottom line.
Yep.
Dow Jones up 4.45 for the month, lagging the S&P, only up 3.64 for the year. The NASDAQ, good month there, up 6.23. Year to date, up 5.48. Small cap stocks had a good month, not quite as good as the NASDAQ, up 4.71. Year to date, still negative. So small company stocks have, they've struggled in this high volatility environment. Seems like we may be seeing a little bit of rotation back there. A little more talk on, being a little better environment for small caps. So we'll have to be patient as always with small caps.
Mm-hmm.
On the international front, international markets didn't have quite the month that U.S. markets did, only up 2.09%. But year to date, developed world, as measured by the EAFE, up 17.33. So international still running strong. Part of that is the effect of a weaker dollar, so that makes international holdings worth more. So, international finally carrying some weight in portfolios. Emerging markets, good month there, up 4.99%. Same thing, your emerging markets are international. They're up 14.23%. Once again, it's been a while since emerging markets finally are working a little bit for you. And then from a bond standpoint, we have seen the longer term rates. We talked about the 10-year. Those rates have come down. We were in the 4.5 plus range. As of today, 4.2 plus. So little retreat there. So the U.S. aggregate bond index up 1.39 for the month. Year to date up 3.65%. So a little bit of relief in interest rates that moves bond prices up.
Yep.
Our portfolios, growth with income portfolio, really our balanced portfolio. In June, up 3%. Year to date, we're up about 7%. So nice start to the year there. Big gainers in June. Nucor up 18, Nike up 17, Nvidia, in a rebound month up 17. Big laggard in June was Toyota. Toyota Motor, we're down 10% there for the month. Year to date, Raytheon's been a big gainer, obviously defense oriented with everything going on, whether it's Middle East or Europe, up 26%. Gold has been a good performer, up 26% year to date. Nvidia, through all the gyrations year to date, still up 25%. Microchip Technologies up 22% year to date. Big laggers this year. So far, Apple down 18. Apple's been struggling.
Yeah.
Seems like they may have found their footing. A little better news coming out of them. I think all the worst has probably been priced into Apple, so we're comfortable holding that. Lennar, the home builder, down 16% year to date. Long term we've made good money in there, but just some of the volatility, talk around housing has hurt them. And then PepsiCo down 13% year to date. Dividend yield portfolio, really our most conservative dividend oriented stock portfolio. Pretty mediocre June, only up 0.3%. Year to date, we're still struggling, down about 2.4. One is these are multinational companies, so you had exposure to really the tariff question marks. I think that's been the biggest detractor, a little more value orientation, and through these runs, value's been kind of put aside a little bit. So not a lot of fireworks in here. So for June, Cisco Systems was actually up 10% for the month, so nice recovery there. PNC up 7%, Chevron up 5%, Medtronic up 5%. Laggards in June, Kimberly-Clark down 10%, Public Storage down 5%. Year to date, our big gainers, AT&T, that's helped a lot in this portfolio, up 27%. AEP, American Electric Power, up 13%. Darden Restaurants up 17% for the month. For the year. Our laggards, Hewlett-Packard, which we just sold, for year to date, we lost about 25% in there. And then Packaging Corp down 16. So not huge. I mean, across the board as a portfolio, not way down, slightly negative year to date. I think, we're just the last couple of days, we're starting to see, that portfolio pick up a little bit of steam. It's a stable portfolio. It has its up and down. It's underperforming right now. I'm not concerned about it at all.
Yep.
Dividends are intact. They're good, solid balance sheets. Appreciation with income. June, great month, up 6%. Year to date, we're about 11% in there. Big gainers in there. Lam Research up 20.5%. Broadcom up 14%. Meta up 14%. EOG up 10%. Amphenol up 10%. Really, our big laggard in June was Zoetis down 7.5%. So not too bad on the downside. Obviously, when you have that big enough, you have too many losers. Year to date, Lam Research leading the pack, up 35%. Cigna up 20%. JP Morgan up 21%. Broadcom up 19%. So financials are doing well. This is a good environment for financials. We've got good exposure there. That's helping a lot of our portfolios. The chips kind of went through a pullback, and now you're seeing, more talk on AI, and the tech has definitely caught a bid again. So, things are moving well there. Year to date laggard, Energy Transfer Partners down 7.5% year to date. That's kind of our worst performer that we're still holding on to. Price potential. This portfolio, we struggled with last year, definitely lagged, throughout the year. Year to date, this year, a completely different story. June, we're up 8.5% in here. Year to date, we're up 11%. Big gainers, Stellestica for the month was up 35%. Advanced Micro Devices up 28%. Meta up 14%. Caterpillar up 12%. Really, our big laggard was Euronet Worldwide, which was down 6%. We actually exited that position a couple days ago. Year to date, big gainers in there. Nvidia, we made 18% in Nvidia. Microsoft up 18%. And I'm surprised we didn't list this, but Celestica, I think, is up year to date since we've held it only since April. I believe we're up 125, 130%. So that's been a big winner in here. That's been a good driver of the portfolio. big laggard in the portfolio is Google, down 7% year to date. I'll talk about long-term price growth. We're getting, this portfolio is growing for us. June up for the year, for the month, up 5% year to date, up 8%. Nvidia up 17%. Planes holding up 10%. Netflix up 11% for the month. Laggards, Eversource Energy down 2%. Year to date, Netflix is our big gainer in there, up 50%. Newmont Mining up 57%. Meta up 26%. Year to date, Innovis down 28%. Apple down 18%. So, like I said, getting more exposure in there. So, relatively speaking, a little newer portfolio has been just smaller. We've just been adding more funds to it.
Yep.
Our SMID portfolio, small mid-cap portfolio, like I said, in June is only up 0.2%. Year to date, we're still down about 11%. So we're struggling in here. Last year had a great year. It kind of ebbs and flows. Big gainers in June. TAT Technologies up 13%. 3IV up 11%. We did sell Radware with a 26% gain. No longer are we holding that, but that was realized in June. Laggards in June. Descartes holding down 12%. Natural Grocers down 20%. Year to date, Radware, like I said, we sold in June, is up 31%. Palomar up 46% for the year. And, really our biggest laggard that we're still holding on to is Amerisafe down 15%. So small caps can be some patience. Dividend yield, those are kind of the two drags on the portfolio. Everything else things are rolling on pretty strong for us. I like our quality bias. I don't think, I think we took advantage of the pullback in April. Mm-hmm. The rotation we did inside price potential, we just kind of stuck to our methodologies, and we've kindly gotten to a place where, okay, we're back on track there. With the small cap, we're going to take that same approach. Stick with our methodologies, maybe make some tweaks to our screening, and we know we'll eventually get back on track with the small cap.
And I think you guys touched on this last month as well. SMID is, intentionally more aggressive in one of our growthier models where you're buying those small caps. So you're going to see, to use your verbiage, you're going to see higher highs and lower lows,
yep,
right? It's just naturally part of owning small companies. We're never going to take distributions from that and use it as a supplement to send money out. It's there as a growthy part
Correct.
Of your allocation.
Absolutely.
Right. Yeah.
Yeah. You look historically, there's more outperforming years, underperforming years, and
yep.
Here we are. So We'll see, but we got 6 months to go and a lot can change. Expectation wise, I think we have some wind at our back for July, with the caveat of, as we roll into next week, the 90-day moratorium on some of the tariffs will be lifted. We think, maybe, who knows, could be lifted.
Yep.
It's definitely going to be a lot of media hype, potential, a lot of headline risk around that.
Things change.
So, they have to expect some volatility.
Sure.
And I think the big lesson is, especially this year, overreacting and making investment decisions, long-term investment decisions based on short-term political moves, mm-hmm. And short-term, news in general has not paid off.
Yep.
And it's, we've always stuck to good quality, long-term investing. Yeah, you get the short-term moves. Sometimes we're trying to take advantage of short-term moves, but in general, we're not making big moves based on the headlines, because the headlines have definitely gone hyperbolic, and rarely do they play out to the extremes that are talked about, and so
Sure.
that are so passionately talked about, that these things never quite go that direction. Things are a lot calmer than what the media wants you to think they are. It's actually fairly boring if you think about it.
Yeah.
We're an economy that's slowing a little bit. I don't think we're falling into 70s style stagflation. I think the Fed's addressing it the right way. And hey, stick to your knitting, keep plenty of liquidity, have funds when you're going to need them, stick with quality, and we end up getting to where we need to be to achieve our financial objectives. Bottom line,
it's all about meeting the goals.
Yep.
And having a long-term focus. We know that, in this climate, there is going to be volatility, but stick to your guns. As you said, have liquidity and have patient long-term capital. That's the best way to grow your capital.
So happy 4th of July, and we will see you next month. Thank you.
Thank you.